Hi friends, as discussed in the introductory video earlier, let's do the quick EDR of the ratio topic. Reminding you again, what is EDR? It is everyday revision. The idea is what? It's all to cover the time gap between the time you learn and the time you give exam. In between हम भूल जाते हैं वो टाइम के लिए 15-20 मिनट का शॉर्ट वीडियोस है एक एक टॉपिक रोज देखने का फटाफट 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 रिवाइज करने का दैट इज अ होल आइडिया अबाउट इट let's start people. So we are going to talk about ratios. See, we know what is a ratio is simply a relationship between two numbers. Why we need it? We have discussed absolute numbers will not depict the correct information and ratio will help you to compare. With absolute numbers you cannot compare. See, we have taken an example like this in the class also, that the sales is given, NPAT is given. Looking at NPAT figure, you cannot arrive at a correct decision. What you must do? You must convert the data into which ratio? Net profit ratio. Once you convert into the net profit ratio, definitely you will be able to give some comparison between the two informations. Okay. How we classify the ratios? We classify the ratio into three types. One is P&L ratios, balance sheet ratios, the second one, and the mixed or combined ratios. As the name suggests, P&L ratio input will come from P&L, both numbers, numerator as well as denominator. Balance sheet, both the numbers will come from balance sheet, numerator as well as denominator. And in a mixed ratio, one number will pick from balance sheet, one number will pick from P&L. Simple. Okay. When we talk about P&L ratios, people, hope you remember P&L ratios, basic. See, I've given you the hints to remember everything, right? So in P&L, guys, how many total ratios are there? Tell me. 5 ratios. Correct. You're on point. Yes. Okay. How next to remember? See, what will be the numerator? Numerator will be the name of the ratio. Very, very, very simple. And what is, if you have learned this from me in the class, you know what I mean, what we are discussing, correct? And the denominator is going to be what? Denominator is going to be net sales. Hey, I hope you are listening. Hello, people. Sir, P&L ratios are very simple, sir. We remember, yes, correct. Total 5 ratios. So, what are the names of the ratios, people? Let's recollect very fast. First one is gross profit ratio, net profit ratio, operating profit ratio, expense ratio, operating cost ratio. Total how many ratios? 5 ratios. Okay. As the name suggests, gross profit ratio. What we discussed in our hints, what we discussed? Name of the ratio in the numerator, net sales in the denominator. Once you know these hints, you can quickly form all 5 ratios. Correct, people? Okay. Let's quickly go to the balance sheet ratios. Okay. When we talk about balance sheet ratios, what is our hint, guys? You remember total how many ratios? 7 ratios. What is a Q? What is our quick word to remember or a keyword? C Q S square D C P. Let's try and recollect what is C. C for current ratio, Q for quick ratio, first S for super quick ratio, then stock working capital ratio, debt equity ratio, capital gearing ratio, proprietary ratio. Let us remember the formulas, people. Current ratio, current assets upon current liabilities. Quick ratio, quick assets upon current liabilities. You can read the description. You can anytime pause the video and read the description. Correct. Super quick ratio. What is that? Cash bank plus marketable securities upon current liabilities. What is stock working capital ratio? You remember, people, what I had told you in the class? It's a very student friendly ratio. As a student, aha, I love this ratio. Why? The first one is stock. Okay, take the stock in the numerator. Second word is what? Working capital. Take it in the denominator. अरे मीनिंग बाद में समझेंगे, पहला एग्जाम में जाके लिख के तो आओ. Sir, उधर closing stock लिखा है. We have answer for this also. Where do we get working capital? It is current assets minus current liabilities. We get it in the balance sheet, people. That's why in the balance sheet, which stock we have? Closing stock. So the formula is closing stock upon working capital. Okay. Debt equity ratio, very simple, very student friendly ratio, guys. Debt upon equity. Take the first word, put it in the numerator. Take the second word, put it in the denominator. That simple, people. That simple. Okay, let's talk about capital gearing ratio. People, you remember what we had discussed, sir? When we write debt upon equity, in equity we have that one fellow, preference share capital, sir. Preference share capital is, to be very precise, very close to debt. Why, sir? Debt has fixed return, preference also has fixed returns. Correct, bachelok? Take it, remove it, put it in the numerator. Debt plus preference capital upon what? Equity shareholders funds. And proprietary ratio, PT, what is that PT? Not the other one, PT, proprietors funds upon total assets. What is proprietors fund? Proprietor fund has how many component people? Four components: equity share capital plus preference share capital plus reserves and surplus minus miscellaneous expenses. And total assets, how many components? Three components: fixed assets plus investments plus what? Did I hear working capital? Wrong, wrong. It is total assets is what? Fixed assets plus investments plus current asset. People, beware. If it is fixed assets plus investment plus working capital, it will become what? It will become application of funds. Correct? Okay. Let's quickly go. See, you want a break? You can pause my video. I will quickly cover it because we want to. What is our target? You remember, no? 15 minutes, one topic, not more than that. Quick revision, quick summarization, quick recovery of the matter. Correct? So let's go ahead, people. So we will talk about mixed and combined ratios. The very first one is what? Profitability ratio in relation to what? Investment. People remember in the class I had given you some hint. Remember the word man on horse. Remember that? When you visualize man on horse, what do you see? You see man above and horse below. Don't visualize the other way around. Returns on capital employed. Something on capital employed. I don't know what will be the numerator. But one thing is sure, I know that the denominator is going to be what? Capital employed. Correct? Half of the ratio. Person asking the question, no, he has to give you half of the answer. Returns on capital employed, so something upon capital employed. What is that something? We have discussed in the class. It is EB. Why EBIT? See, it's quickly written. Those who are watching these videos as a last source, sir, we have not attended your class, still we want to know something. Okay, a quick income statement has been prepared, and then we have written what is capital employed. Capital employed is debt plus equity. Everybody's payment, people, everybody's payment starts from where? It starts from which profit? It starts from EBIT. Remember that? I have highlighted interest, preference dividend, equity dividend. All the payment starts from EBIT. Hence the formula is what? EBIT upon capital employed. Okay. Returns on proprietors or shareholder fund. What is that? NPAT upon shareholder fund. People, returns on shareholder fund, no? So denominator is shareholder fund. A, to all the shareholders, you have to pay preference dividend and you have to pay equity dividend. From which profit you pay A? You pay from NPAT. So numerator is NPAT. It is that simple, people. Returns on equity shareholder fund. Apply your brains, people. Apply your brains. Returns on equity shareholder fund. So denominator is going to be equity shareholder fund, and for them which profit is available? Payesh is available. And fourth one is technical, returns on equity share capital. Okay, Payesh, instead of dividing by shareholder fund, I'll divide it by what? Equity share capital. Profitability ratios, higher the better. Let's move forward. Let's talk about turnover ratios, people. How many total turnover ratios? 7. All of them are what? Efficiency ratios. Remember the hint? Sales are alike in the numerator, name of the ratio in the denominator. Barabar. Quick recollection. Quick. Okay, let's start. The first one is capital employed turnover ratio. Formula would be sales upon capital employed. How efficiently you use your capital for generating what, people? For generating sales is the whole idea of this ratio. Correct? We have kept a very, very, very basic example. You could pause the video and see this example. We have covered this in the class. Then total asset turnover ratio, sales upon total asset. Fixed asset rule, our rule continues. Name of the ratio in the numerator. Sales in the numerator and name of the ratio in the denominator. Yes. So total asset turnover ratio is sales upon total assets. Fixed asset turnover ratio is sales upon fixed assets. Very simple. What is that? How quickly or how efficiently you use your fixed asset for generating sales. Okay. Working capital turnover ratio, sales upon working capital. Because see, only fixed assets cannot bring the manufacturing. No, so to bring the manufacturing, you have to apply your working capital also, right, people? Okay, stock turnover ratio, very interesting. No sales, but it is a stock, no? So sales or it's alike. Because it is stock, I can't take sales, but I'll have to take this cost of sales. So that is cost of goods sold upon average stock. There are some reasons. See, people, cost of goods sold upon average stock. Why? You know, you remember? Formula for COGS we had discussed in the class. COGS is equal to what? Opening stock plus purchases minus closing stock for a trader. And even if he's a manufacturer, it would be opening stock plus COP minus closing stock. So basically, opening and closing stock is bound to be there. Bound to be there. Understood? So we take which stock? Average stock. And see what is the whole idea? How quickly you buy the goods, how quickly you sell the goods. Recollect, we have discussed this in the class. It is very good to quickly purchase and quickly sell the goods, and very less inventory remains. We had discussed, that if we are at some unknown place and we want to eat in a hotel, so we observe two, three hotels and we try to go to that hotel which is fairly occupied. We avoid a deserted, not desert, Re Bapa, not the sweet. I'm talking about a deserted. Means nobody is there inside the hotel. We avoid such hotels. Why? Because we are worried, we are afraid that the stock may not be fresh over there. Right, people? Let's talk about debtors turnover ratio, which is credit sales upon average debtors plus average bill receivable. What is the whole idea? How quickly you sell. See, the first part was, see, these ratios are also interconnected. Stock turnover ratio is what? How quickly you buy and how quickly you sell. But that doesn't end over there, na. After you sales, you should recover also, no. So debtors turnover ratio talks about that. How quickly you sell, how quickly you recover, right? Faster the better, sooner the better. Okay, see, like we have taken some numbers. Credit sales we taking constant only 24, 24, 24. Average data we are changing. Here you see average data are 12, means the debtors turnover ratio is only 2 times. Here it is 6 times, here it is 12 times. But which one is the faster? Option C is a fast turnover, so but obviously we will select this option. Okay, and creditors turnover ratio is what? How quickly you purchase and how quickly you make the payment. Okay, that completes with the turnover ratios. People, hope you remember this thing that we had discussed earlier. This part, this part, this part. What we had discussed, you remember? Let's see. Imagine a balance sheet. We have equity, debt, and current liabilities. We have fixed assets, investments, and current asset. So first of all, on the liability side, you have capital employed. So first ratio, capital employed turnover ratio. What you do with this all capital employed turnover ratios? You buy fixed assets, investment, and current assets. So total asset turnover ratio. Then what you remember? Fixed assets are very important. So we remember the third ratio. Then what we say? Arey Baba, but fixed assets cannot work without working capital. That is CA minus CL. So we have the fourth ratio, that is working capital turnover ratio. Then we split the working capital as current assets minus current liabilities. So in current assets, there are two important: stock and debtors. Every business will always have stock and debtors, people. Always. So stock turnover ratio, debtor turnover ratio, and the last one, current liability, will always have what, people? It will always have creditors. So creditors turnover ratios. Done, people. Let us talk about the other important ratios. Okay, earning per share, guys. We'll always calculate this for which shares? Equity shares, no, because we're not supposed to do it for preference shares. They know in advance, right? So what is the formula? You want to calculate earning per share. What to do? Take the total earning divided by number of people, not number of people over here. It will be number of equity shares over here. Earning per share. So take the PAESH, profits available for equity shareholders, divided by what? Number of equity shares. People, what will be dividend per share? Take the total equity dividend distributed divided by number of equity shares. Very simple. Okay, we take one random example that the NPAT is 120, preference dividend is 20, and number of shares are 10,000. So people, out of the NPAT of 120, we will give away 20,000 only to the preference shareholders. So we'll be left with 1 lakh rupees of PAESH. Take that 1 lakh and divide by 10,000 shares. Per share 10 rupees. Ray. Got it. Now let's say the company gives away 40,000 as a dividend for all the shareholders. So 40,000 divided by 10,000, it will be 4 rupees per share, dividend per share. Acha guys, you tell me, how much did you pay per share? 4 rupees out of 10 rupees. 40%. So you have DPS upon EPS, as you can see. Or, well, sir, I don't want to do it this way, sir. I want total price and total dividend. Are do it na babu, ratio it will come same. 40,000 by 1 lakh. How much? 40%. Acha, tell me, out of 10, you distributed 4. How much you did not distribute? First of all, you tell me what we call it. We call it retention. So how much we retained? We retained 6 rupees out of 10 rupees. Percentage is 60%. Book value per share. What to do, people? Take the equity shareholders fund divided by number of equity shares. Price earning ratio, earning price ratio, very, very, very important. People, EPS upon MPS. Okay, what it tells you. See, let's take one example. Now, both these companies have a MPS of 100 rupees only. So, what a layman would say, sir, price same, sir, buy any share. Are what buy any share? Check, know how much it is earning for you. Now, use your common sense, Babu. 100 rupees you are buying the share. This share A is earning 20 for you. Share B is only earning 10 for you. Are you mad or what to buy B? No, sir. We will always buy share A. Correct now, people. So convert it into percentage. Now, it will give you the same answer 20%, 10%. Oh, that simple, brother and sisters too. Yeah, okay. Okay, sir doesn't want to be gender inequal. Yeah, brothers and sisters, everybody included. P ratio inversely like a straightforward P multiple. Okay, MPS upon EPS. And I've told you in the class, people, as a student, I love this ratio. Why, sir? Sir, very simple, sir. Price is the first word that reflects NPS. Earning is the second word that reflects EPS. What it tells me, people. See now, this share I am buying for 100 rupees and it is earning 20. I'm continuing with this example. Okay, we have already decided we'll buy A, so we'll just confirm. See, this share I'm buying for 100, it is giving me 20 rupees of earnings. So I'm paying how many times of earnings? 5 times of earnings. Here I have to pay 10 times of earnings. Yeah, too much here. I have to pay 10 times. It's very costly. I'll buy this. So what is very simple? Lower than industry, buy the share. Higher than industry, the P ratio higher than industry, sell. Debt service ratio or interest coverage ratio, all we call it. What is the whole idea, people? Interest on debt is fluctuating or it's fixed? Fixed. It's a tension. So what do we want to know? That whether we have covered our interest expenses well or not. See the example, formula would be clear to you. Both companies have a EBIT of 2 lakh rupees only. है ना? So you say, sir, they are at the same level, sir. Are but look at their interest. This is interest is 20,000. Here the interest. Oh my God, sir, 1 lakh rupees interest. Oh my God, his interest is his income. I can say EBIT is just able to cover the interest how many times? 2 times. Here, like, sir, tension not, sir, bindas, sir. Interest is only 20,000, sir. I have 10 times the money of the interest money, sir. EBIT is sufficient. So who's more safe? Bachalo, higher coverage is safer. Okay, you remember the examples that we took in the class. You want to travel from one point to the other point. Charges are say 40 rupees. You have exactly 40 rupees in your pocket. Can you reach? Yeah, theoretically you can reach. But in between something happens, some emergency happens, the rickshaw wala tire burst, puncture happens, something happens. You can't get the other auto, you have no money. So the risk is more. The day you are carrying 500 rupees in your wallet, 400 rupees in your wallet, you're comfortable. Okay. Even if I lose this, even if I cannot continue in this auto for some reason, even if it doesn't return me my money, no worries, sir. I have my provisions like that. Then we come to preference dividend coverage. Coverage only we're talking, no people. We pay preference dividend of which profits? NPAT. So NPAT upon preference dividend. Equity dividend coverage also we are discussing. Huh, bachala? Why so? Because it is Paish upon total equity dividend. Debt service coverage ratio. People, very interesting this is. Okay. What is that? It is after tax cash profits available for payment of installment divided by annual installment. So how we reach on after tax cash profits? You take NPAT, add back depreciation. Till here, people are comfortable. People are, because sir, this is depreciation is a non-cash expenditure. Sir, very true, friend. People are like amortization. Sir, non-cash, sir, add it. People are, sir, you're adding back interest. Why, sir? Interest is a cash expenditure. Or a baba. What am I checking? I'm checking my ability to pay the installment, which also covers interest. So when should I check my ability to pay? Before payment or after payment? Any payment I'm going to do, I'll check my ability. Forget about installment, right? Any payment I want to do. I go to a shop, I want to buy ice cream, 20 rupees. Small ice cream, 20 rupees. When should I check the available money with me? Before buying only, no? I open the wallet, oh, 40 rupees. I can buy two. I will buy one, but the coverage is 2 times. So NPAT is already after deducting interest. People, what to do? Add back interest to check the ability. Now people again pounce on me. People say, you added interest. You you did not add principal. Or my dear student, principal was never deducted. Only we are talking about PNL, NPAT, add back depreciation, add back amortization. भैया interest add करना पड़ेगा क्योंकि पहले माइनस हुआ था भाई. Principal is written in the balance sheet. Under the loans, we deduct loan repayment. It was never written in PNL. Why the hell should I add it? Okay, higher coverage is anytime better. Dividend yield ratio or dividend price ratio. Bache log remember dividend price. First word is dividend, so take DPS. Second word is price, take MPS. Correct, people. What is the whole idea? You remember? Because you remember the example that I had given you. Company gives dividend on which value? Face value. Correct. But we don't buy the shares at face value, we buy at market price. So company shares, we are giving 300% dividend. They give 300% of face value, 10 rupees, that is 30 rupees. And I bought it for 3,000. Guys, my returns are only 1%. Okay, so this is a quick summary of the ratio topic. Hope you go through this, and then some extra module ratios we had done. Hope you remember them, right, people? We had done difference interval ratio, we had done Tobin skew ratio, which is there in your class notes written. So please go through all that, and wish you all the best, and see you in the next quick revision. I hope you remember this, what I very specifically told. Revise this all when you have free time. 15-20 minutes video we are going to make. Watch this video, theory gets refreshed, the big part of the topic gets refreshed, and I would be very happy if you share with your friends, right? Because we share the knowledge and we grow together, guys. Is that correct, friends? Is that understood? Thank you so much. See you in the next video. Bye.